Happy Monday, everybody. Welcome to another episode of China Update, where we discuss leading political, economic, and geostrategic news and analysis on the world's number 2 economy. My name is Tony. Now, I have returned to New Zealand for 2 weeks. I am filming this at a friend's house, so please forgive the informal setting for the next few weeks. That said, though, we have a very big and busy week ahead, so let's jump in. The Trump administration has moved to exclude smartphones, laptops, and other consumer electronics from its steep new reciprocal tariffs on Chinese imports in a significant concession aimed at calming global financial markets and assuaging tech industry fears. The decision, made public by the US Customs and Border Protection late Friday, marks the first sign of any softening in President Trump's tariff rollout, which began with the imposition of 145% levies on Chinese goods last week. The exemption is a major reprieve for big technology companies including Apple, Microsoft, and Nvidia, all of which saw their share prices plunge in the immediate aftermath of Trump's announcement of the tariffs on the so-called Liberation Day, that is the 2nd of April. Apple alone lost $700 billion in market capitalization over several days as fears of a prolonged trade war sent Wall Street into a tailspin. The decision is expected to offer temporary relief, particularly for Apple, which still relies on China for about 80% of iPhone production, despite recent efforts to diversify into India. However, the relief may be short-lived. On yesterday, Commerce Secretary Howard Lutnick warned that smartphones and related electronics would still be included in an upcoming probe into semiconductors, which could lead to a fresh wave of tariffs within months. Quote, "They're exempt from reciprocal tariffs," end quote, he said on ABC's This Week. Quote, "But they're included in the semiconductor tariffs, which are coming in probably a month or two," end quote. Asked whether iPhones might again be subject to tariffs, Lutnick confirmed, quote, "Correct, that's right," end quote. The back and forth reflects the broader uncertainty plaguing US trade policy. The US president has already imposed 20% tariffs on all Chinese imports in retaliation for China's role in fentanyl manufacturing, and has warned that further levies could be applied if China refuses to negotiate. In turn, China raised the tariffs on US goods to 125% this weekend, vowing to, quote, "fight to the end," end quote, against what it called unjustified protectionism. Beijing welcomed the US technology exemptions as a, quote, "small step," end quote, but urged Washington to, quote, "completely cancel," end quote, its reciprocal tariff regime. Over the weekend, the Ministry of Commerce said there are, quote, "no winners in a trade war," end quote, and warned that continued escalation would hurt both sides. Still, the White House remains steadfast in its push to force technology manufacturing back to American soil, or at least away from China, though analysts question the feasibility of such a shift, that is, towards the United States. Indeed, experts say producing iPhones in the US remains highly unlikely. The scale, infrastructure, and skilled labor required for final assembly, testing, and packaging, known as FATP, exist almost exclusively in Asia. Apple's so-called iPhone City in Jiangzhou, in central China's Henan province, employs hundreds of thousands and includes dormitories, medical facilities, and schools. Instead, Apple is betting on India, a country that now hosts the world's second-largest iPhone plant, capable of producing 35 million units annually, enough to fill much of Apple's US demand, but not all. Other factories in Southeast Asia focus on less complex products like iPads and MacBooks. Meanwhile, economists warn that even the limited tariffs already in place could drive up consumer prices and dampen economic growth. New York Fed President John Williams said inflation could reach 4% as a result of the sweeping levies, while hedge fund magnate Ray Dalio warned that the US is approaching, quote, "something worse than a recession," end quote, if the situation is not handled carefully. Despite the exemptions for consumer electronics, the vast majority of Chinese-made goods still face significant barriers. A review of US imports data reveals that 46 of the 50 most China-dependent product categories remain subject to tariffs, including electric fans, toys, microwaves, and gaming consoles. Some companies, like Mattel, have already indicated that prices will rise, while others may simply stop importing goods altogether. Moving production out of China is no simple feat. Many Southeast Asian countries are increasing manufacturing capacity, but experts note that complex products like smartphones and game consoles require highly specialized supply chains and skilled labor that are difficult to replicate quickly. In the meantime, American consumers may be left with fewer options and higher prices, while US technology companies must brace for further volatility. As Peterson Institute trade expert Chad Braun observed this week, quote, "We'll have to wait and see if the exemptions this time around stick, or if the president once again reverses course sometime in the not-too-distant future." End quote. Meanwhile, Goldman Sachs strategists have lowered their 12-month targets for major Chinese stock indices for the second time in April, citing intensifying US-China trade friction. The note observes, quote, "US-China trade tensions have soared to unprecedented levels," end quote, warning of decoupling risks across capital markets, technology and geopolitics. Goldman, previously bullish on Chinese equities, had raised its MSCI China target to 85 in February, supported by optimism around AI developments such as DeepSeek. However, the index has since dropped over 8%. It is going to be a big week for US-China relations generally, and this escalating tariff trade war specifically. We are witnessing the world going through a tremendous change. If you want to be on top of all the updates as they happen, make sure you're subscribed to China Update. And if you're getting some value from today's episode, don't forget to hit the like button. Let's continue. China's investment in research and development, R&D, surged to new heights in 2024, reaching 3.61 trillion yuan, approximately half a trillion US dollars, an 8.3% year-on-year increase, according to a recent report by the Dalian University of Technology, DUT. The report underscores China's growing emphasis on innovation, with R&D spending rising 84% since 2018, nearly double the pace of GDP growth over the same period. China remains the world's second largest R&D spender after the United States, and its expenditure in 2022 was over 3 times higher than that of Japan and Germany, the third and fourth largest spenders. China's R&D intensity, the ratio of R&D investment to GDP, rose to 2.68% in 2024, aligning with levels seen in other advanced economies in the G7, though still below the US's 3.59% in 2022. Despite this progress, the report identifies significant shortcomings. China's per capita R&D spending in 2022 was $128,000, well below the US and even trailing Italy, the G7's lowest spender on a per capita basis. Furthermore, only 18% of China's R&D went to basic and applied research, compared to roughly one-third in the US and Japan, and 60% in France and Italy, according to OECD data. Report co-author Sun Yutao urged greater investment in basic research, warning that overemphasis on experimental development may limit long-term scientific breakthroughs. He also noted the importance of separating R&D from technology commercialization, especially in regions with underdeveloped innovation ecosystems. Regionally, southern China led the way, accounting for 67% of R&D expenditure in 2023. Provinces like Guangdong, Shanghai, and Zhejiang dominated, while Beijing and Shandong were the only northern regions in the top 10. The private sector has become the dominant force behind China's innovation drive. From 1995 through 2022, enterprise-funded R&D rose from 30 billion yuan to 2.4 trillion yuan, making up 79% of total investment. Huawei alone spent more on R&D in 2022 than half of China's top 10 listed firms combined, though some would argue that Huawei shouldn't exactly be seen as a private actor. Meanwhile, government contributions, though important, accounted for only 18% of the national total, with local governments outspending the central administration. And finally for today, China's exports surged more than expected in March, providing a brief economic lift before the full impact of sweeping US tariffs hits global trade flows. Official customs data released Monday, today, showed exports in dollar terms climbed 12.4% from a year earlier, well above economists' forecasts of 4.6% and a sharp acceleration from the 2.3% gain in the first 2 months of the year. The jump in outbound shipments helped widen China's trade surplus to $102.6 billion US dollars, significantly exceeding expectations. However, and this is critical, imports fell 4.3%, a steeper drop than the 2.1% decline predicted. I'm sorry if I sound like a broken record, but this once again signals continued chronic weakness in domestic demand and reinforces that China's domestic market cannot be a substitute for the United States. March's strong export figures were likely driven by front-loading ahead of the US tariff escalation in April. Exports to the US rose 8.8% in March after falling more than 11% in February, suggesting Chinese exporters were rushing to ship goods before the tariff deadline. But with little sign of de-escalation between Washington and Beijing, analysts expect China's export momentum to fade quickly in the second quarter. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a good Monday, have a productive week, and I will see you all tomorrow.